So what is up, crypto family? We have quite a doozy of an update for you today. It's a lot of information, but it's really, really important. So without further ado, let's get going. So what you guys can currently see on the screen is first Bitcoin. This purple line is the 200 daily exponential moving average. This orange line is the S&P 500, which is basically the US stock market, and the same with this orange line, which is the Dow Jones Industrial Average. So these are going to be our proxies for the stock market, and we're looking at price from pretty much the 1st of January. And before we take a look at what's basically been causing this crazy price volatility in the last 60 days, we're going to take a zoomed out view and show you the bigger picture so you take this short-term price action with a pinch of salt. So the first thing we have to notice is that Bitcoin is up year to date, so from the 1st of January, over 24%. Even with the corona sell-off and everything, we are currently up 24% year to date. We opened at around 7,000 this year. This is again well above the 200 daily exponential moving average. We had the sell-off from the around the 10th, 11th of March, and price swiftly retook that 200 daily exponential moving average, and we had a successful support retest here. So we are well back above the 200 daily exponential moving average, which means that investor sentiment is still bullish for Bitcoin, right? And if we take a look at the S&P 500, the market is down 7% year to date. And the Dow Jones is doing even worse. It's down almost 13% year to date. But so Bitcoin is still looking like a really good asset in comparison. We're above the 200 daily exponential moving average, unlike a lot of these stocks. But another thing that I want to point out is if we look at pre-crisis, so from this area here left, we can see that there isn't too much of correlation between the stock market and the crypto market, right? So for example, if you look here, we can see we were quite flat during this period, whereas here we had an exponential bull run and then a tank as well, whereas the stock market was quite flat during that period. However, if we look at post-crisis, so from here to the right, we can see that the correlation between traditional markets, so our equity and stock markets, and Bitcoin is much, much higher now. So for example, we can see there was an uptick in stocks here, there was an uptick in crypto there. There was a crash in stocks here, there was a crash in crypto here. So the markets have a very, very high level of correlation at the moment, or post-COVID crisis. And we're actually going to show you that it's the highest it's been almost in its entire history shortly. But why is this important? Well, we all know pretty much why the corona crisis caused a mass market sell-off, right? Because the economy shut down, we didn't know what the impact was going to be. But then people sort of came out with forecasts, and we put together more or less what we thought it would take for the economy to turn back to normal, etc., etc. But over the last 60 days, when we've actually been taking a look at the data, we can see that the data didn't match up very well with what we'd forecasted or what the analysts, etc., had forecasted. And this actually caused a lot of volatility in the market and uncertainty in the stock market. And the sort of volatility we've been seeing in stocks is, again, unprecedented. So before we take a look at the actual data, let's just look at it visually. So to the left here, we can see before the crisis, and look at the size of the candle bodies, right? Look at the size of the price movements in a single day relative to after the crisis. So just for example, look at this one candle here, or this one candle here, or this one candle here, or this one candle here. This candle here probably looks like 10 to 15 times the normal daily price movement. So we can see that the stock market, just on a daily basis, has been extremely volatile relative to normal trading activity, right? So it hasn't just been that the market's been going down, it's been that the market moves in a day typically 10 times as much as it normally does. And with crypto markets being so highly correlated to stock markets, that obviously is a very negative thing for crypto. So what that means is when we see one of these big red candles, like we're seeing exactly playing out today, that pull down in or pull back in stocks actually pulls the entire crypto market down, and more so over the last 60 days than any other time in Bitcoin's history. So to fortify this fact, what we are going to do is let's take a look at, the macro statistics. Bit of a lag delay there. And what we're going to be taking a look at is Bitcoin and the S&P 500's realized correlation, right? So this dark blue line is the 1 month correlation, and this light blue line is the 1 year correlation. And what can we see happening here, particularly from mid-May? So like we said, over the last 60 days, what has happened since mid-May? Look at this blue, both the light and dark blue lines. They've absolutely spiked. And if we look at the top right here, relative to all the way back to July 2019, we can see that the yearly and monthly correlation between Bitcoin and the S&P 500 is at an all-time high. So those two markets are tied together as closely as they have ever been. And obviously, with all the negative news coming out in traditional markets, that has proved negative for crypto. So that's what's led to a lot of these sort of unforecastable moves in crypto, where we may have a beautiful structure and setup in crypto, but suddenly we see poor numbers coming out of some states in the United States, and that's pulling traditional markets down, and that pulls crypto down as well. So unfortunately, over the last 60 days, we've been seeing a lot of disparate data coming out between what was expected and what was actually realized, and that caused a lot of volatility, as you guys can see in the candles. So what exactly is going on? And you guys who are into stocks and traditional markets will also really enjoy this bit that we're going to take a look at. So we've had some really severe crashes in our, well, not even in our lifetime, in almost recorded history or modern history. And the earliest that we look at is the Great Depression. And that's really the benchmark against which any crash and crisis is measured against, because the economic effect of it on the world was so severe. And you're going to realize why that's actually scary at the moment. We had Black Monday, which was an anomaly event. We had the 2000, so the tech boom, the dot-com bubble, and then the Great Recession, which was just the 2007-2008 financial crisis, right? So these are some pretty big boys that we're seeing, some of the worst economic times in human history, in terms of modern human history, when we've had organized markets, etc. So what has the corona crash looked like in comparison to these crashes? So during the Great Depression, the stock market basically plunged 89% from its pre-crisis peak. But it took 34 months to do that. During the 2007-2008 crash, markets fell by 49%, so they almost lost half their value. But this took 16 months. While during the coronavirus crisis, markets, or the Dow specifically, has fallen 37%, but only between February 11th and March 23rd. So in about 1.5 months, the markets have fallen almost what it took the 2007-2008 financial crisis 16 months to do to the market. So I hope you're really starting to grasp how unprecedented this is in terms of market activity, and what a severe time we're actually living through at the moment. So let's take a look at what the impact on the real economy is, right? The guys, the street vendors, the shops, the real economy, right? Not just financial markets, because that's essentially what determines how markets will react and rebound. So during the Great Depression, GDP shrank by about 27%, which is huge. More than a quarter of all the economic activity in a country just disappeared. Well, during the 2007-2008 financial crisis, which all of us would be old enough to have lived through, will know the millions of people that lost their jobs, the massive global economic depression or downturn that ensued, right? Well, GDP only contracted 5% during that crisis. During the COVID crisis, GDP has already contracted by 4.8% just in Q1 2020. And unfortunately, most of Q1 included no corona activity, right? January, February, March. Only towards the end of March did we actually get the coronavirus really hitting the market. Well, what's happened during the coronavirus? We're expecting Q2 GDP to drop by 30% in the US alone. What that means is that 30% of economic activity just won't exist, relative to the previous quarter in 2019, just won't exist. And you can see by looking at what's happened during the Great Depression and the 2007-2008 financial crisis, that in a lot of respects we're at least, if not worse off at the moment. And there's still a long way to go. So markets are really facing an unprecedented time. We're living through a chapter that's going to be contained in a lot of history books. And we still haven't seen the determining factors that are going to let us know exactly how this crisis is going to play out. So we'll look at some of that disparate data just now. But for example, we have no idea when a vaccine is going to come out, what the vaccine is going to be made of. So we don't know how easy it's going to be to produce and disseminate across the world, how long it'll take for populations to achieve herd immunity. All of these things are still variables that are pretty much up in the air. And until we know those things for sure, we won't know what the economy and by extension the market is going to look like over the next few months. So the International Monetary Fund already predicts that it's going to be the worst downturn for the world since the Great Depression. So worse than the 2007-2008 financial crisis. So just to give you guys a visual sort of look at what's going on, markets across the world have absolutely tanked. Even with that sharp recovery they had, they are still massively down. In the US, the average weekly jobless claims are 350,000. In the first few weeks of April and May, they've been 3.3 million, 6.8 million, 6.6 million, and so forth. A factor of 20 and at best 10 times the normal level of unemployment there, right? Let's even forget about oil crashes. So because of this contraction in economic activity, a lot of countries, a lot of first world countries as well, are expected to experience a detracted recession for at least the remainder of 2020 and quite a significant portion of 2021. But again, until we know for certain some of these answers to some of these variables, exactly when that is going to happen, we will not know. So let's take a little look a little bit closer to home. So we can see that even here in South Africa, economic activity is expected to contract by 16.1%. And you guys will already know they're expecting our unemployment rate to go well over 50%. And the thing with the unemployment rate is it does not include all of the unemployed people. It's a strict definition. So the real unemployment rate on the ground is probably going to look, if it's declared at 50, it's probably going to be closer to 60, 65%. And that really goes beyond purely an economic impact. And you have to start thinking about the social impact of when you have 2/3 of an economy that's unemployed, unable to feed themselves, and 1/3 living in opulence, and what's really going to be the situation on the ground here in South Africa. But that is not part of our analysis. It's just an interesting and scary conversation I like to have with a few of my friends that are analysts. So that's pretty much all we want to take a look at here in South Africa. So, what's caused the volatility over the last 30 days? Well, apart from a lot of disparate data coming out that didn't match what expectations and forecasts were, we can see that a lot of states in the United States are experiencing record numbers of coronavirus cases after easing their lockdown restrictions and thinking that the worst had sort of passed. And let's take a look at how this looks. So, in the US overall, we can see that we were experiencing a downturn in cases. And ever since mid to the end of June, we can see a roar in upward cases that is now, these bars represent the number of daily new cases. And we can see the last 2 days of data here match almost pretty much the two highest days on record. So by no means is the US near past this crisis. That's what this data is telling us. And in specific states, which are actually the most, a lot of them are the largest and most economically productive states in the United States, you can see the cases have almost doubled their previous all-time highs. In California, for example, daily new coronavirus cases in Florida have almost doubled their peak, and you can see we had a downturn here. They eased restrictions, and look at what's happened to daily new cases. Texas, we can see that they really are in the worst of the pandemic at the moment, and you've really got to ask yourself, how are governments going to respond to this? Because China as well has seen an uptick in cases. So what this means on the ground is the reinitiating of travel restrictions, which shuts down the sort of global flow of trade of goods and services, and the potential tightening of lockdown restrictions as well, which then, sort of brings economic activity or reins it down back in. So we still have a lot of uncertainty to go when it comes to traditional markets. And as we've seen with our own eyes at the moment, the correlation between traditional markets, so our normal stock market, and cryptocurrency is at an all-time high. It is the highest it's been in years, or ever actually. And that realized correlation means that sometimes completely external events are having a very negative effect on crypto. I mean, because the correlation's high, it could also have a positive effect. But what we are looking for is that correlation to break down a bit. And we can even see from the crypto sector as well, coronavirus has been changing how crypto markets are trading. And although the effects have been quite predictable, since March 11th, we enjoyed some good trading activity. As of the last 60 days, when we've seen a lot of this disparate traditional market data coming out, and mismatches and fears of a second wave, that it has really impacted the cryptocurrency market. But in saying that, let's now take a look at our crypto market. So we can see, after really fighting to keep this 9.3 level, which is the bottom of our old range and the top of our orange range here, as a support, we've now broken down, and we're coming back here to our buy zone, which is this red rectangle from about 8.7, where bulls really need to fight price back up. So in the short term, we've got our 200 daily exponential moving average that's propping us up from about 8.5, 8.7. We do think price is going to go there, and we do need to see price hold this level, or else it really could spell some trouble. And the reason being is, as you can see, this could just be wicking action, but at the moment as we speak, we've broken below our symmetrical triangle, which you guys will know is a key level. And breaking below the symmetrical triangle and turning the top of this triangle, so this black line here, into an area of resistance would be extremely bearish for price action. Because when we're above this triangle, our price range is this 9,000 to 10,400 area. But if we had to break back into the triangle and confirm the top of this as a resistance, our new range would then be about 9,000 to 7,300, so to speak. Technically, it would be 9,000 to 5,800. So you can see how we really do not want to break back into this macro structure. But because we are at such a critical point, one piece of negative news could literally take us straight back into the structure. We are holding levels quite nicely at the moment, and we can see that the S&P 500 is currently in a 2.4% drawdown, which is massive for traditional markets. So as you can see, this is the cause of our current crypto market drawdown. But as we pointed out before, one thing that's very interesting is crypto usually draws down a lot more than traditional markets, but as of the last 60 days, we've seen it draw down on an equal basis. So we've pulled back 2%, the stock market has pulled back 2%, and in the long term, this is quite positive. We're seeing a reduced volatility to external events, and that's very, very good. So although we have this short-term negative sort of dark cloud hanging over our heads, which is equities, there is a bit of positive news to come out of this. That is not it. So we've been closely tracking Ethereum since the beginning of the year. And for those of you who don't know, towards the end of this year, Ethereum will be making an upgrade to the network, the Casper upgrade, which will transition the network from proof of work to proof of stake. And what this means is that Ethereum validators will no longer be machines or ASIC miners, but it'll be retail investors or anybody really like you and me who run a validator node. And in order to run a validator node, you need a minimum of 32 Ethereum. So why is this important? It's important because over the next few months, this upgrade is expected to take place between Q4 2020, or perhaps there's a lot of talk of it being pushed back to Q1 of 2021. But either way, when this transition takes place, validators or potential validators will need 32 Ethereum in order to run a validator node. So what does that mean in terms of price? So in terms of price, it means two things. One, between now and November or January of 2021, once Bitcoin gets a little bit of stability, people are going to be acquiring Ethereum or accumulating Ethereum in order to run these validator nodes, right? Because people want to make money in the Ethereum network, and Ethereum is the most resourced sort of smart contract platform at the moment. So there's a lot of resources going into Ethereum, and obviously once they transition to proof of stake, people are going to want to run these validator nodes. To run these validator nodes between now and then, they're going to have to make sure that they get their hands on 32 Ethereum. So between now and then, we've got two things happening in the mechanics of the market. People are going to be accumulating Ethereum, so there's going to be an increased demand, especially once we get some stability from Bitcoin's price. And two, because people are going to want to be running these validator nodes, they're not going to be selling the Ethereum, right? So there's going to be a constriction on the supply of Ethereum. So we're seeing an increased demand and a constriction on supply, which is the perfect recipe for meteoric price appreciation. And if we take a look at the data, this actually becomes a lot more clear. So the first thing we're going to take a look at is addresses. So Ethereum addresses that are holding a balance greater than 10. So let's put it on, So obviously we're going to want to take a look. So we can now see since June of last year all the way to just before June of this year, we see something really interesting happening, right? So this blue line is the number of Ethereum addresses that have a balance higher than 10 Ethereum, right? So people who are accumulating Ethereum. And even throughout a massive, massive price dump here, we can see a steady uptrend. Even during a massive price appreciation here, we see a steady uptrend. No matter what is happening to price, there's a clear, steady, and predictable uptrend here. And what that tells us clearly is that people are already accumulating Ethereum. And obviously, this plays out perfectly into our theory. So, what we're doing is over the next 2 weeks, we'll be releasing a report. The first of two reports, the second one we'll get to in a second. And what it's going to do is it's going to outline the Ethereum project and the roadmap for Ethereum. We're going to look at a few very key data points, such as this, and we're going to show you exactly how to navigate that journey in terms of investment. So, if you really believe in Ethereum, and we really are, we think it's an amazing, unprecedented opportunity to generate wealth over the next 6 to 12 months as this sort of transition plays out on the network. So we're going to be compiling a report that navigates you through exactly how to invest your way through this journey with Ethereum 2.0. The second trend that we have been tracking will be something that I'm sure you guys who are more familiar in crypto would have heard of as of late, and that is Defi, or decentralized finance. And the first sort of notable player in the space was really MakerDAO. And we've seen some really, really big players jump in the space recently. So Compound's had its Coinbase listing, etc. Synthetics, Balancer just launched and saw some massive price spikes. So between projects like Compound, Synthetics, Balancer, Aave, Kava, Bancor, some of these projects have seen 600, 700% appreciations over the last few months. So why weren't we excited then, and why are we so excited about DeFi projects now? Because Ethereum's transition to proof of stake means that the network's functions improve massively in a lot of areas. So, for example, when they introduced a protocol like sharding, the scalability of the Ethereum network increases exponentially. So it can handle a lot more transactions, a lot more efficiently. Obviously, it can run a lot more applications. And that means that these projects can really, really shine in this environment. So we've already seen a lot of market interest in these projects prior to the Ethereum 2.0 upgrade. And we feel that these projects are going to continue to accumulate value as that upgrade or transition to proof of stake approaches. So if we even just simply take a look at the amount of value locked in these projects, you'll see quite a clear upward trend. So currently there's over $1.6 billion locked in decentralized finance protocols like lending and decentralized exchanges, etc. And there is a big demand from the market for these type of projects. So our second report is actually going to guide you through navigating the DeFi space. And we'll sort of tell you exactly which projects have really high potential in the space, how to navigate your way through those projects, their roadmaps, what to look out for, potential exit values, and a lot of really useful information that will help you invest your way through the upcoming or the DeFi explosion that we really feel is going to occur over the next few months. So obviously, as loyal members, you guys will pretty much be getting those guides at hugely discounted rates, pretty much almost free. And the last thing we would like to touch on before we let you enjoy your weekend is the fundamentals of the crypto market are still exceptional. So don't get lost in the short-term picture of traditional markets drawing us down. So let us take a look, for example, at the log scale for Bitcoin addresses. And we can see since July of 2019 to our current state, the number of addresses on the Bitcoin network are still steadily increasing. So more people are still using the network, right? even if we take a look at active addresses, so we need to just smooth that out a little bit. We can see that there is still a lot of new interest coming in the market. The market is still has a lot more active daily users, right? And the key fear that we had post-halving was obviously of miner capitulation. And that would manifest itself in the Bitcoin hash rate just completely tanking. So here we can use the 7-day moving average. So I can just show you some important data points. So here we have the halving event, right? And we can see that there was this orange line as the Bitcoin hash rate. And after the halving, we can see that the hash rate did crash, right? So this was a bit of minor capitulation, really just probably obsolete and old machines being switched off. And prior to the halving, our hash rate was about 116,000. In fact, our all-time high that we peaked at was here around 120. I think it was actually 123, but around 120,000, right? Well, after the crash, we can see we peaked, and currently the hash rate levels have returned to and even bettered these pre-halving levels. So we can see pre-halving, we averaged around 108, 111, 115, and we are currently back at those levels, right? So the fear of miner capitulation has really gone down. People are still using the Bitcoin network. We can see that even if we take a look at the average fee on the Bitcoin network, after spiking just after the halving, we've returned to a relatively normal level. So it's just as efficient to use the Bitcoin network. More people are still using the Bitcoin network. More value is flowing through the Bitcoin network. And the Bitcoin network is just as secure as it's ever been, as we've seen from the hash rate. So the fundamentals of the crypto market at large are still great. It is unfortunate that we've seen us really being tied to traditional markets at the moment. And I just want to excite you a bit before I let you guys go for the weekend. So Willy Woo is one of the most renowned analysts in the space. I definitely urge you guys to follow him. He's developed a lot of the proprietary models that we use to value crypto assets and time market cycles. And I'd just like to show you something interesting. So he developed a proprietary indicator that's actually able to accurately predict bull markets, right? So we can see here's an indicator, and every time the indicator bottoms and turns upward, we've seen an ensuing bull market. Indicator bottomed, turned upwards, and we saw an ensuing bull market. The indicator bottomed, turned upwards, and we saw an ensuing bull market. Again, and so forth and so forth. Well, the indicator actually indicated that we should have been, and in fact, we can see the rumblings of the beginning of a bull market towards the beginning parts of this year. But the COVID crisis is actually an outlier event that prevented this. And in fact, looking here, this becomes quite clear. At every turnaround point in the indicator, we've seen an ensuing bull market. I wish I knew what the indicator was, but it's Willy Woo's proprietary indicator, right? So after the point, bull market, bull market, bull market, bull market. But although the indicator flashed bull market here, we saw an ensuing crash. And that is sort of evident proof that this event was an outlier event for Bitcoin's price action. And we can see that this has been backtested all the way to 2012. So for all intents and purposes, it seems like it is quite accurate and indicative. So that is about it, guys. We hope you have an awesome weekend, and we will be keeping our eyes on more opportunities and more trading opportunities in order to obviously provide you guys the best trades. So we hope you have an awesome weekend, and that's it from us.